Same biryani, same city, same rupees 400. But here is the one thing that nobody tells you. The company delivering it is not making the same money on your order. Not even close. In FY26, Zomato's parent company posted a net profit of rupees 366 crores, while Swiggy a net loss of rupees 4154 crores. Both selling food, both huge. One prints cash, one bleeds it. And the reason is one metric most retail investors have never even heard of: contribution margin. This one number is the difference between a stock that quietly compounds your money and a trap that looks exciting and bleeds shareholders dry. So today, we will discuss about unit economics using a single biryani order. Then, we will open the audited FY 2026 annual reports, go segment by segment, food delivery, then quick commerce, and by the end, you will know exactly which of these two giants is actually profitable. Why one prints rupees 366 profit while the other loses around 4000 crores, and how to use this same test on any platform stock for rest of your investing life. Imagine you ordered rupees 400 rupee biryani. To you, it feels like one payment, but inside the app, that rupees 400 splits into maybe 6 or even 7 money flows. And whether the company survives depends entirely on what's left at the end. So, let's tear it apart rupee by rupee. First, the app takes commission from the restaurant, roughly 20 to 22%. On rupees 400, call it around rupees 88. Then, there is that little platform fee, just rupees 7. Feels like nothing, right? But hold on that rupees 7 in your mind, because it's secretly the most beautiful number in this whole screen. And the delivery and the handling charges you paid, say around 30 rupees. So, the app's total takes on the order is roughly around 120 to 125. Here is what the tiny rupees 7 matters. Zomato did nearly a billion food deliveries in this year, 979 million to be exact. Now, charge rupees 7 to 10 platform fee on almost every single one of those. That's several hundred crore rupees a year, and it costs the company almost nothing extra to collect. No rider, no restaurant cut, no packaging. It's close to 100% margin cash. This is the quiet lever both companies have been pulling, quietly raising that platform fee order after the order. And it barely shows up on your bill. A small number, giant impact. That's what scale does. Now the costs. The delivery partner has to be paid. That's the biggest one, maybe around rupees 50. Then the discount they gave you to win your order, another 28 rupees. Payment gateways, servers, customer support, round it to rupees 9. Subtract all of that, and what's actually left? Around rupees 20. That leftover, that's your contribution margin. It's what one order contributes towards the company's big fixed cost: salaries, tech teams, marketing, the head office. Here is the rule you need to remember. If contribution margin is positive, every new order pushes the company closer to the profit. If it is negative, every new order pushes it closer to the death. More orders literally makes a loss-making platform lose more money. That's the whole game. So now let's check for Zomato and Swiggy, what does the real audited data actually say? Now, here is where most beginners get lost. You open the annual report, you scroll to the profit and loss statement, and you go looking for food delivery profit. And it's not there. Just one big blended number. That's because a company's reports overall number on the main P&L, but the segment by segment breakdown lives in the notes. That's where the real story hides. And look what it shows. On food delivery alone, Zomato's segment result was 2079 crores. Swiggy's was around 1041 crores. Read that again. Zomato earns almost double the profit Swiggy does on food delivery business. Same business, roughly twice the money. Why? One word: density. In FY 2026, Zomato did 979 million deliveries. Swiggy did around 714 million. That's roughly 37% more orders flowing through the same delivery fleet. And that is the part people miss. A delivery rider costs the basic fixed per trip, whether he carries one order or 3. So when you have more orders packed into the same neighboring apartments at the same time, one rider can batch 2 or even 3 orders on a single run. Suddenly, that flat rupees 50 rider cost is being shared across multiple orders. Your delivery cost per order quietly falls. And on almost a billion orders, shaving even a few rupees of each delivery adds up to thousands of crores. That's operating leverage, not a buzzword, an actual rupee advantage that compounds every extra order. Put it in per order terms and it clicks. Zomato squeezes around 20 to 21 rupees of operating profit out of every food order. Swiggy, roughly around 14. Now Swiggy is not the villain here. Their food contribution margin actually improved to 7.5% this year. They crossed 1,000 crore in food EBITDA, up 77%. Their food businesses is genuinely healthy. So if food delivery is fine for both, then where on earth that rupees 4,154 crore loss is coming from? To answer that, we have to walk into the room where the real money is being burned. Quick commerce. This is 10-minute grocery. Blinkit for Zomato, Instamart for Swiggy. Both are building dark stores, mini warehouses that only exist to pack your order in seconds. By March 2026, Blinkit had 2,243 of them across 250 plus cities. Instamart had around 1,143, and here is the exact same lesson from before now playing out with groceries. A dark store has a fixed cost, the rent, the staff, the electricity, whether it does 500 orders a day or 1,500. So the whole game is how fast can you fill it with the orders and spread that fixed cost thin. Blinkit did 917 million orders this year. Instamart did around 412. That's more than twice the throughput per dark store network. And that density is exactly what flips a dark store from bleeding to earning. And the audited numbers show it. Blinkit's losses shrank to rupees 277 crores for the year. And crucially, it actually turned profitable at the operating level from the third quarter onwards. Instamart's contribution margin is still negative, minus 2.8%. It's improving. It went from minus 4 to minus 2.8, but it is still below zero. And remember our golden rule? There it is. There's your rupees 4,000 crore hole. Zomato's quick commerce arm posted a positive segment result of rupees 430 crores. Swiggy's Instamart posted a segment result of minus 3,063 crores. Instamart is scaling hard, growing 94%. But because its contribution margin is still negative, every bit of that growth is widening the loss, not closing it. By the way, if you want the exact template I use to break down any platform's unit economics like this, order value minus every cost bucket down to contribution margin, I have put a simple unit economics tracker in the description. Plug in any company and it does this tear down for you. It's free, links below. So let's zoom out and put up the whole thing on one scorecard. Food delivery, both positive, both healthy, Zomato just deeper in the green. Quick commerce, Blinkit positive and turning the corner. Instamart is still in red, and it all adds up at the company's level. And you get the two numbers we opened with. Zomato's parent, Eternal, did 54,364 crores of revenue and landed a net profit of around 366 crores, while Swiggy did around 23,000 crores of revenue and a net loss of around 4,154. And now you understand why. It was never really about food. It was about whether the second engine, quick commerce, had a positive contribution margin or not. So here is your golden rule for evaluating any platform stock, Zomato, Swiggy, or the next flashy app that IPOs next year. Before you look at the revenue growth, before you look at the users' numbers, ask one question. Is the contribution margin positive? Because a company with positive contribution margin that's still showing a loss is usually just young. Scale will fix it. Like Blinkit, it's proving right now. But a company with negative contribution margin is running a race where the finish line moves further away when it runs faster. And don't just check if it is positive. Check the direction. Look at whether the contribution margin is climbing quarter after the quarter. And try to spot the exact quarter a segment flips. That's precisely what happened with Blinkit in the third quarter of financial year 2026. And the market rewards the flip hard, usually before it shows up in the headline profit. So the investors who read the segment note early saw this contribution margin turning and understood why. That person was months ahead of the crowd, starting only at the net loss line. That's the edge this one metric gives you. One honest caveat, none of this is a buy or sell call. And I am not your financial advisor. Contribution margin tells you if the engine works. Valuation, competition, management, that's a whole lot different story. This just makes sure you are never fooled by a growth number again. So the next time someone tells you this app is losing, sell it, or the opposite, it is growing 90%, buy it now, you will know the real question to ask. Mastering contribution margin and unit economics gives you the power to spot a genuinely profitable tech platform before the market catches on. But what happens when it is not young tech app? When it's a 100-year-old Indian industrial giant that wipes out thousands of crores of debt to turn its balance sheet net cash positive. In our next breakdown, we are taking Tata Motors balance sheet, the exact same forensics way we just did this one. Click right here to jump into the full stock teardown playlist, and I'll see you in the next one.